In this session, I'm going to talk about the asset pricing models. And though there are a couple of important asset pricing models, I would be more and more focusing on one of the very popular asset pricing model called capital asset pricing model or CAPM in short. If we look at any of these asset pricing models, their main objective is to get into the absolute pricing of the security, right? They help us in determining the true price or the absolute price of the security, or they help us in terms of valuing the assets where majority of the assets have uncertain cash flows, both in terms of amount or in terms of timing. So where the cash flows are very much uncertain, which means where there is a risk that is built into the cash flows, if I have to really value those particular assets in combination with their risk or based on the assessment of their risk, if I am getting into the valuation of the assets, there also the asset pricing models come into picture. And just theoretically to give you some kind of an insight, there are two major, I'm just saying major because there are so many other asset pricing models also in place, but one is the capital asset pricing model which I am going to deal with now, and we also have another important model, arbitrage pricing theory, which is built upon the CAPM model, but conceptually I'll give you what are the kind of differences that exist between the two. So they have some set of assumptions different, right? So, but these are the two commonly used models for typically pricing the assets. And one more important point before we move even more further in this is we have to understand the concept of relative pricing. The relative pricing concept says is whatever is the risk, right? When I am talking about a risk of a particular security, the risk of that is already bundled into its price, right? So more risky security should attract more price, or should be sold for cheaper because there is a high risk that is involved in it. So the return that it should give is much higher compared to a low risky security. So the risk is already bundled into the price. That's what the relative pricing concept talks about, which means once I do the pricing of this security, any of the assets that are derived from this, right, that is what we call as derivatives. Any of the securities that are derived from the original security, so the risk does not play any kind of additional role because the risk is already bundled into the price of the original security itself, right? And as a part of this session, what I am going to look at is the return of the assets, whatever each asset or portfolio I take up, I am looking at the return of the asset versus the risk. How do I link these two elements? How do I measure the risk of the security or the portfolio? How do I measure the return? And what is the kind of linkage that is existing between the two? So we'll get a data from the markets, right? What all kinds of data that we require is something that I would be talking of, and we would also be getting that kind of a data. And once we have the data with us, we really need to model the dependence between the return and the risk. Now this is where I would be using the concept of linear regression. Linear regression is a kind of a concept that will build the relationship between the return and the risk, and on the top of that we'll perform some hypothesis tests to really assess the significance of the result, right? So this is what we are going to deal with. So we'll get the data, and based on the data we will try to compute the CAPM, the capital asset pricing model for a security. So before we start the computation process, let's try to understand some basic theoretical aspects regarding the capital asset pricing model. First of all, it uses economic considerations based on the various economic factors this model is derived. The formula has lot of assumptions, right? Some of them are realistic, some of them are not. It says the individual investors are price takers, right? As an individual investor like me, I cannot influence the price. I have to buy or sell my asset at the price the market decides for me. I'm not a price influencer, I'm a price taker. And it makes an assumption that all investors have a single horizon for investment. So there is nothing called short term, long term, all of them invest. You, me, everyone invests for the same time period. Probably it looks like something to question, but yes, when this model is developed, these are some of the assumptions that have gone in. And whenever people are investing, that investment is limited to those securities that are traded. So the assets which are not traded, it is assuming that there is no investment in them, which may not be true, right? Some of the assets may not be traded at all, but some investment has gone into those assets. But CAPM assumes that all the investments are typically going only in those assets that are traded, which means in another way, if I have to put, every asset in which some investment has been made, it is traded in some form or the other. Then it's also making a few assumptions. There are no taxes and no transaction costs, which is a very ideal world which we are not operating in. And then when it comes to the information about the various assets, various companies, performances, it says that the information has no cost. Information is freely available to every investor. In reality, it is not. Some information is very, very expensive. But though these are the kind of assumptions that have gone in while developing a model, even today this model has been a very popular model for pricing the assets, in spite of all these assumptions that have gone in. And when it comes to investors, it assumes that all the investors are rational, and everyone goes with mean variance optimization. We have looked at the portfolio optimization framework, so where we are optimized on the mean return versus the risk that is involved with the portfolio. It assumes that every investor is rational, and for them mean variance optimization is the model for investment. And in that case, everyone will invest in the same portfolio, and that is what we are calling as the market portfolio. So everyone will invest only in that combination, and all other combinations will not be invested. And it also says the expectations of each of the investors are homogeneous. Every investor has the same set of expectations regarding the mean, variance, and all the other properties of the asset. There is no difference of opinion among the investors, right? So these are all the assumptions using which the CAPM model has been derived. Now, this market portfolio is something when the investors are rational and when their objective is to optimize the mean versus the variance, every investor is holding the same portfolio of risky assets. Right? So this market portfolio actually contains all the securities and the proportions of each security is a percentage of the market value of the security to the total market value. So that is the kind of proportions the whole market portfolio will be held in. Now this is where when I talk about the risk premium is nothing but the extra risk for that extra return. And it says that the risk premium is primarily based on the average of the risk aversions of all the customers, because all of them are investing in the same portfolio. The overall risk premium of investing in the entire equity markets is coming out to be the average of the risk aversion rates of each of the individual customers. Now this is where mathematically the relationship comes out as, when I am looking at individual securities return, I am simply saying the expected return of a particular security I, the risk premium of it, means subtracting the risk free rate of return from it, is some beta times the expected return of the entire market minus the risk free rate of return. So this is the kind of a linear relationship that is existing between the market risk premium. Market risk premium is how much extra return the market is giving over and above the risk free rate of return, and similarly the individual risk premium. So it says that the individual risk premium is linearly dependent on the market risk premium. Where I am talking of this expected RI is the expected return on a particular security, let's say Tata Consultancy Services TCS, the expected return on this particular security. This I talk about the risk free rate of return, which is typically the treasury rate, the government treasury bill rates, or in some cases I can also use as interbanking rate. In the example that I am going to showcase, I am going to use MIBOR, which is Mumbai Interbank Operating Rate, which is more similar to LIBOR in the international market. MIBOR is more and more specific to the Indian market. So I am using RF, which is the risk-free rate of return, expected rate of return on the entire market portfolio, and the risk is measured in terms of beta. And typically this beta is measured as the covariance between the individual securities return and the overall market return divided by the variance of the market returns. This is the traditional formula that goes towards beta. That is a measure of risk of that particular security. So this is more and more, if I look at the interpretation of this beta, I am talking about from the perspective of the sensitivity. Sensitivity of the stock's return with respect to the overall market portfolio. Right? How much sensitive? If the overall market has changed by some extent, what is the kind of change that has occurred in the particular security? So that is what is traditionally captured through beta. Or I can also interpret it in a slightly different way. When I am talking about a beta, I will look at how much risk this particular security adds to the overall market portfolio. So if I am talking about one single security per se, how much risk is added by this particular security to the overall portfolio. So in case the beta is higher, one thing which we can understand here is the more and more is the value of the beta, the expected return also for that security should be higher. The more is the beta for a particular security, the expected return for that security also should be higher, because if I rearrange this equation, I say the expected return of that security is equal to RF plus beta times the expected return on the market minus the risk-free rate of return. Right? In equilibrium, what this concept says is, in normal conditions, in equilibrium situation, every security should hold this particular relationship. So this is typically called as the security market line. And what it says is, every security in a regular scenario, the return of every security should be following this particular equation. Right? So if it is not the case, then the equilibrium is lacking, and every investor can typically change their portfolio, means they can actually buy or sell those securities which are underpriced. They can buy those securities which are underpriced, and they can sell those securities which are overpriced. So that's the way, the conceptually we can understand the CAPM. The final output of the CAPM comes out as the expected returns of the security based on the risk of that particular security with respect to the overall market portfolio. Right? So that's the kind of conceptual understanding that I am bringing in to the CAPM. Of course, arbitrage pricing theory is also another theory, but when we are doing it in R, we are typically looking at only the CAPM. But just to give you some kind of theoretical insights into the arbitrage pricing theory, let me just see what differences this arbitrage pricing theory brings over and above the CAPM. Even this is also for determining the return on the security, the expected return of the security. But some of the things that it says is, no arbitrage, in a typical equilibrium condition, no arbitrage condition will exist. Means there will be only one price. If the cash flows are more or less similar, the risk levels are more or less similar, there cannot be two different securities with two different prices. All others remaining the same, the price should definitely be the same. Otherwise, people will exploit that opportunity by by buying the cheaper one and simultaneously selling the expensive one. Right? So what this says is, the expected return of any particular asset is a kind of linear combination of multiple random factors, not just one. Different kinds of random factors. So what it simply says is, the expected return on a security is a kind of a linear combination of the multiple factors. So these factors, they could be either all the macroeconomic factors, like GDP, inflation, etc., or there could be different kinds of market indices, So basically this model has become more and more of a mathematical or a statistical model. You give different kinds of inputs. All of them are the drivers of the expected return. So it simply says expected return is the kind of alpha, which is each security's specific stuff, plus whatever are the different kinds of factors that I am talking of. The sensitivity of this particular security to each of these factors and some error term. So this is the kind of equation that is going for arbitrage pricing theory. So which means there are different kinds of factors, macroeconomic, company specific, market specific. So different kinds of factors that I am identifying, finding out the sensitivity of this particular security with each of these factors represented as beta ij, and the security specific returns which is specified through alpha I. So that is what is typically coming out as the model for risk arbitrage pricing theory. So this factor portfolio is a very important aspect here, which is typically talked of as a well diversified portfolio, and it reacts only to one of the factors, means the beta will be 1 for that particular factor and it will be 0 for all the other factors. So the expected return, because of this logic, the expected return on the security here comes out as the risk-free rate of return plus the betas for with respect to each of the risk premium. The beta with respect to each of the risk premium overall is giving me the expected return. So basically in this case, if you look at here, if I simply look at only one factor instead of multiple, and that risk premium I am taking as market, which is nothing but expected value of RM minus RF, then in that case the arbitrage pricing theory is getting narrowed down into a CAPM model itself. So basically we talk about the CAPM is a scaled down version of the arbitrage pricing theory, wherein only one factor exists and that factor is the market risk premium. So before I start applying the estimation of the beta and the CAPM equation, I just want to give you some kind of differences between the CAPM and the arbitrage pricing theory model. So first thing I can talk about, this is more and more of an equilibrium model, whereas this is purely a statistical, because it is asking you to consider the different factors and try to build a model linking all the factors with different returns. And here it assumes that the relationship between the return and the risk comes with a well diversified portfolio. I can construct in reality this well diversified portfolio, whereas here the entire market portfolio is what is required, and it's almost literally difficult to construct that kind of a portfolio in reality. And if at all there is some kind of a mispricing, it is possible that some investors make a buy and sell decisions and get a fair price, whereas here it requires that all the investors have to make the buying and selling. So probably theoretically this is looking more and more difficult to implement, whereas here there is a kind of a practical implementation that is very much feasible. But what we see is here the gray area is what all factors I have to consider. how many factors I have to consider. There is no clear-cut definition on all the factors that need to be considered for arriving at the return. So this modeling is left to the analyst in terms of what factors need to be considered for the modeling purpose, right? So now let's get started. So the first part is I have to get into the beta estimation, and I can go with the beta estimation based on the past price data. So we'll take the past prices data. So we'll first, as an activity, first let's collect the data, and if required, some kind of a synchronization, because here I'll be collecting two different kinds of data. Here we'll collect one stock price data. I'm trying to collect the TCS data. Then we'll also collect the index or the market portfolio, which is what I have taken as Sensex. And we would also collect a risk-free rate of return, for which I have taken MIBOR as the proxy. And within this MIBOR also I have taken the 1 month MIBOR. So these are the different kinds of data that I have collected. All these are collected from the exchanges only, right, from the exchange. These two are collected from Bombay Stock Exchange, and this data is collected from the NSE. And all this is stored in one file. If you look at the Excel sheet here, so the MIBOR right from April 2013 till 31st March 2016. So 3 full years data of MIBOR has been collected, and during the same period the stock and the Sensex have been collected. So the TCS price also, TCS price as well as the Sensex are captured right from 1st April 2013 to 31st March 2016. So this is the data that we are going to work with. So the first step is, how do I get this data from Excel sheet into R? Then if at all some kind of synchronization is required, how do I do that synchronization, because the data is coming from different sources? So how do I really get into the synchronization of the data? And then I'll have a method to estimate beta. We'll talk about the formula mode, and we'll also have the statistical mode of estimating the beta, and any kind of a linear regression model which actually helps us to predict the expected return based on the risk which is measured in terms of beta. So that is what is the process. So initially let me collect the data, let me download it into R, right? I have already talked about this data and this data. So these two data, let me get into R. So I've just opened R. So the first thing, stock and index. So let me get the stock and index data. I'll do a read.csv and I'll give the path. So wherever you have stored, you can give that path. So I have saved it in this particular folder in my H drive, training videos, financial analytics using R, and I have stock and index price.csv. So this is where I'll get the stock and index data, and I'll also get the MIBOR data as well. So I'm doing a read.csv even for the MIBOR. So even I have saved this also in the same location. The only thing is the Excel sheet, the CSV file is different. It is named as myborrates.csv. So if you want, you can quickly do a check on the data types. So overall, right, you can look at the internal structure of your stock and index as well as MyBor. So I am doing stock and index, the internal structure. It is saying it's a data frame. 741 observations are there. Out of which the date is considered as a factor. It's not considered as a date. So obviously I have to convert it into a valid date. TCS, it's a number, and Sensex is also a number. Fair enough. But this is something that I have to work upon because it's a factor. It has to be a date. Similarly, let me look at the structure of MyBor as well. Even that's the same problem with MyBor as well. It's a data frame, but it has only 714 observations. So there is some kind of a discrepancy between the two. Though I have collected it over a 3-year period, here I have 741 observations, here I have only 714 observations. So there is some difference. Some days something is not present, some days something is present in excess. We don't know. So this is where the synchronization of the data will play an important role for us. So right now, let's keep that aside. But before that, we have one more job to do. Right, the date in this also is a factor. So both the dates have to be converted into a valid date format. So if you remember, if I have to convert the factor into a date, right, if I have to convert the factor into a date, we have this code, right? First we'll do a as dot, first we'll have as dot character, right, where we first convert that factor into a character, and once that is converted, then we'll apply as dot date on it with the format in which that particular character is typically present. So the same logic I want to give. So I'll say stock and index. I'll overwrite the same column. So that's where I'm saying stock and index $date. I'll overwrite it by first taking as dot date, or first going with as dot character, right, as dot character. I'm taking stock and index $date. So first I am converting stock and index data frames a date column into a character, and after that I am converting it into a date, because once it gets converted into a character, this is the kind of format I am going to get. Right, this is the kind of format I am going to get. So I'll say format is equal to, so the first part is the date, so I'll put it as %d, then we have hyphen, month is in a shortened format, so which is %b, hyphen, the year is in a 2-digit period, so which is what I'm calling it as %y. Okay, as dot character, I should not have it as a capital, so this C should be a lowercase letter. Okay, so the stock and index date is now converted. For quickness, let's just check stock and index. Now we got the date column as a date format, no more a kind of variable kind of a format. It's a date format. Now the same logic, let's apply Now the same logic let's apply to MyBor as well. So MyBor, the data is present in this kind of a format. This is DD YYYY. So the same logic let's use, and then let's try to convert. So I'll say MyBor dollar date. I'm overwriting the same. So we'll talk of as dot date, as dot character, MyBor dollar date, and this needs to be converted into a format. Okay, what is the format? First thing is month in a number form. So that's where I'll put percentage %m slash, then I have the date. So I'll put percentage %d slash, and I have the year in the longer form. So the 4-digit year is mentioned as percentage capital Y. So this is what has become to my MyBor date. So I have put my MyBor date. So let me just check now the structure of MyBor as well. Yes, I have 714 observations. No, but the date format is showing NA. I think in the Excel file that I have downloaded, we have two different formats. Here we have 2nd April 13 and here we have 3103. So let's change all of them to one single format to be consistent. So I'll change all of them here to this kind of a format itself. Right across I'll have the same kind of a format, which means I have to read through this stuff again for MyBor. So let me read the MyBor again. Right, and now let me convert the MyBor using not this format, but it is percentage %d hyphen percentage %b hyphen percentage %y, because we have it in that same format. So MyBor is coming out like this, and now let me check MyBor again. The structure, yes, now it is looking in a date format with this kind of values. Okay, so both the data have been brought in, right? So I have the MyBor and I have stock and index. And now we know that the dimensions of both of them are different, because here there are 741 observations, whereas here there are only 714 observations. So there could be some dates which are present in stock and index, but they are not present in MyBor, or it could be vice versa also. Now this is where I really need to have a mechanism to filter out only those dates that are common in both of them. And in the set language, it is like using the function called intersection. So we also have a function of intersection here, which will bring in those particular dates which are an overlapping and filter based on those dates itself. So those kind of things I'll take it into, let's say, valid dates or common date. So let me call it as C date, which are the dates that are common between the two. So I am applying the intersect. So I'll use the intersect function, wherein I am capturing the two different dates intersect. I am typically looking at the stock and index dollar date. So I am looking at that particular date versus MIBOR dollar date. So I am just looking at those particular dates where the intersection exists between the two. So if I am looking at C dates now, the C dates, yes, there are almost 700 and whatever. I can find out the length to know how many C dates are overlapping. Okay, 714 dates are overlapping between both of them. So I can use the C dates to get the list of all the dates. So now I'll simply look at a filtration of the entire data frame to include only those particular dates, right? So that's where I'm creating. Okay, I'll have now three different values, three different vectors. One I'll have for TCS, right? Three different vectors. I'll have one vector for TCS, one vector I'll have for Sensex, and one vector I'll have for RF. So now let's get the data which are in the form of vectors for each one of them. So I'll take TCS. So out of the overall stock and index, I'll pull only the TCS specific data. So I'm taking a subset, right? So stock and index, out of this stock and index, I want a subset where the stock and index dollar date, whatever the date that I have taken in stock and index, that should be matching. So how do I do the matching? I have a percentage in percentage. That's doing the matching job for me. So I'll look at it in C date. So wherever the stock and index date which is present in the dates, and for that I will, so wherever this kind of a matching is happening, I'll only pick only those rows, right? My subset is where the date is matching with the C dates, and I'll pick only the second column. Second column contains the TCS data. So this is where the TCS data will be there. And similarly, I can capture the Sensex data also in the same way. So I'll copy this code, except that instead of second column, I'll pull the third column for the Sensex data. And similarly for MIBOR, I'll pull from MIBOR. So I'll say MIBOR. Out of that, I am taking a subset where MIBOR dollar date is present in C dates, and out of that I am simply taking the second column. So this is what is MIBOR. So probably quickly I can check what is there in TCS. Yes, these are the TCS prices. Then I can also check what is there in Sensex. These are the Sensex values, and I can also check what is there in MIBOR. So these are the MIBOR rates for those periods where there is a kind of overlapping. So which means now I have cleaned my data, right? Though the data has different time periods, now I was able to bring all of them to a common time periods. So I have taken those particular dates where the dates are common to both Sensex and stock and index file, as well as the MIBOR data file. Then the next important task, once my data is ready, I have to get the returns. I have to compute the returns for each one of them. And better thing is get a continuous returns, which means I'll be using the logarithmic function for them. So better I'll write one function called log returns. If you remember, one way of directly finding out the logarithmic of returns is I'll take the log, right? I'll take the tail of the entire vector except the first column, or except the first from the last, which is the last value, and I divide it by the head of the prices except the first. So this is what will definitely give me, so which is nothing but log of P2 by P1, right, or log PT by PT minus 1. So this is what is applied here. So the same thing I can write it as a function because I can apply it to each and every stock separately, or each and every data separately. I can do it for Sensex separately and for TCS separately. Anyhow, I have to do it slightly different for my bar. I'll tell you why. So either I write a function or I can directly apply for both of them. Either way, again it's my comfort. So let me write one function called log return. So let me write one function called log return. So I am talking about function of x, and as a process I am putting this particular function wherein I am taking the logarithm of the tail of x comma minus 1. So take the entire tail except the first element of the tail, which is the last value of the data, and you divide it by the head of x. Take all the elements of x except the first data, right, and then find the logarithm of the same and close your bracket. So you have a function called log return, which you can apply to any of the stocks now. So basically, if you want to find out log return of TCS, you will get the log returns. So you can very well apply to each one of them. Probably if you want, you save it so that you might use it better. Log return TCS is the one variable that I can find out. I can store, and I'll say log return of TCS, and similarly I'll say log return Sensex. I'll store it as log return of Sensex. So I've created new variables which are capturing the log returns values of both of them. So we can compute the risk premiums, because as per our equation we are trying to build the relationship between RI minus RF versus RM minus RF, right? So I require the risk premiums for all of them, and for that I have to link it with the risk-free rate of return. So I have to subtract the risk-free rate of returns from the log returns for each one of them. And if you see, we have used MyBar, and generally MyBar is quoted on a money market basis. So the return I will not quote it in the same way as I have quoted for the stocks. So I'll be, because the money market basis is nothing but it's an actual by 360 kind of account. So it takes the number of days as 360, and the actual is the difference between the periods. So because of this reason, if I have to really compute my RF, I'll take it as the logarithm of 1 plus whatever is the MyBar I have, that MyBar I divided by 360, and I take the difference in the number of days, difference between the two dates, and I divide it by 100. Or basically it's like my bar divided by 100, because my bar is typically in number terms, not in the decimal terms. So this divided by 100 will convert it into percentage. So I could have very well said the denominator is 36,000. So my bar number divided by 36,000 into the difference between the dates, I can take it and I'll take the logarithm of that, and that is what will give me my RF, right? And T and T minus 1 are calendar days here, not the trading days. So this is where in some cases the difference could be 1, and if there are some non-working days in between, the difference could be 3, 4, 5 as well. So overall I can find out the risk-free rate of return. I'll find out the risk-free rate of return, for which I am taking the logarithm of 1 plus, I need to take the MIBOR divided by 36,000, and but I don't want to take it for the first because I cannot get the difference of the dates with respect to the previous. So I'll still employ the head of MIBOR, and I'll not take all, I'll remove the first one. So I'll take the head of MIBOR minus 1 divided by 36,000, and I multiply it with the difference between the C dates. C dates actually contain all the dates that are valid. So I am getting my risk-free values. So I can take my head of risk-free to just check what they contain. So these are the things that are coming as a part of the risk-free. And I can even look at the entire structure of the risk-free. The structure is numbers. There are 700 numbers, 13 numbers that I have, and these are the values that are associated with the risk-free rate of return. So I have 713 numbers associated with the risk-free rate of return. So I can very well get the risk premium that is associated with any particular security on any particular day is nothing but the return that is associated with that security on that particular day minus the risk-free rate of return associated on that particular day. So this is what is typically coming up. Now comes the next process where I have to estimate the beta of this particular security. So I have the individual asset, right, TCS. I have got the log return for it. I have got the index, which is the Sensex. I have got the log return for it. So basically now comes the beta, which comes out as the covariance between the security returns or probably risk premium associated with TCS and risk premium associated with Sensex divided by the variance of the risk premium associated with the Sensex. So this is what is the computation of beta. The same logic, I can go with beta TCS. That's the name, let me save it. I'm calling it as covariance between the log returns of TCS. We have already got log return TCS minus the risk-free rate of return. So this is one element. Similarly, I want log return Sensex minus the risk-free rate of return. So which are the risk premiums of both of them? And I have to divide it by the variance of log return Sensex minus the risk free. So I am getting the covariance divided by the variance. So this is what is the value of beta, right? So I can very well get the beta of TCS coming out as 0.54, and the interpretation wise, if the beta is greater than 1, I'll say that this security is more risky compared to the market. If it is equal to 1, I'll say it's more or less equally risky as that of the overall market. And if the beta is less than 1, it can be regarded as a kind of a defensive security. So it is less risky compared to the market. So I can very well estimate the beta of any of the securities in this particular manner. So once I know the risk, I'll have the mechanism to really assess what should be the expected return of this security given the risk associated with it. Right? So we have directly used the risk premium instead of the return. Now, so we have estimated the beta from the time series. This beta will go as an input along with the risk-free rate of return in terms of determining the expected returns of the TCS using the risk premium kind of an approach. Now, the next important thing that is coming out is how do I estimate the same beta from a linear regression kind of a mechanism, because that is what will help me to find out the relationship between the return and the risk, which can really help me out in terms of doing the predictions of the return. So the linear regression is typically used to estimate the beta, right? So I'm using the dependent variable and the independent variable in any linear regression. So the independent variable will be my market risk premium, right? What is this market risk premium? RM minus RF. So my independent or explanatory variable here is RM minus RF, whereas the dependent variable for me is the risk premium of the security. So this I'll take it as a dependent variable, this I'll take it as the independent variable. This particular regression equation wherein I am looking at the risk premium of the security versus the risk premium of the market, it will be of the form some alpha I plus beta I times this. So this is what we are calling as the security characteristic line, or typically the characteristic line, SCL. And this particular mechanism in R is very easy, but theoretically if I look at the ordinary least squares method is used to determine the linear regression. So we have alpha. So this particular part, so because we are getting alpha I plus beta I time, alpha is that which is otherwise called as an intercept. So that portion of the stock return which is not explained by the market, so which is stock specific, that particular part of the stock return which is not explained by the market, and the beta which is the slope of this particular equation is basically a measure of sensitivity of the securities return with respect to market return. So we can actually try fitting this particular equation or fitting this particular model. So I'll first save it as a part of the fit where I am doing a linear regression. My dependent variable is log return minus log return TCS minus the risk free. That is my dependent variable, and this dependent variable I am modeling with a tilde sign where my independent variable is log return sensex minus risk free. So this is the kind of a fitment that I am trying to do, and when I am trying to call that fit to see what exactly went into it, it is saying that the intercept is, so the model is coming out like this. The intercept is 8.5 into 10 to the power of minus 5. Which is what is 0.00008569. And along with that, the slope is coming out to 5.441 into 10 to the power of minus 1, which is coming out as 0.544. If you remember, this is what is the beta that we have got even using our covariance and variance kind of a mechanism. 0.5453. 0.54. So at least, so this is the kind of mechanism that I can use even for the estimation of the beta. So I can very well identify the characteristic line of TCS, and even I can do the plotting of the same. Right, so I can very well do the plotting. Let's see how we can get that. I'll take in the plot, I'll take on the x-axis, I can typically take the risk premium associated with the market. So I'll typically say log return sensex minus risk free. That I am taking on the x-axis, and I can say log return TCS minus the risk free. That I am taking on the y-axis. So if I am doing this kind of a plot, okay, this is the typical plot that we have got, and on the top of this I can actually draw the fitted line. So for that I will take the AB line. AB line I can do it as a fit, and probably I can put the color of it, let's say as green or something. So to this I am plotting the AB line. So this is the typical regression equation that has come up. So on the x-axis I have taken the risk premium associated with the market, and the y-axis I have taken the risk premium associated with the stock. And as per the CAPM, so if you look at this equation, this is what it is, right? So the RI is, as per this model, it has come out as RI minus RF is equal to some alpha I plus some beta I times Rm minus Rf. This is what, plus some epsilon. Now what we are saying is, this has a mean of 0, so I can take this out. But as per the CAPM, this will not exist. So alpha should be equal to 0 as per the CAPM. So I can very well set alpha to be 0, and I can still go ahead with my model. So if I have to set alpha equal to 0, then better thing is, into the same model that we have created, the fit model, The modification that I'll do is I'll put along with the risk premium associated with the market, I'll put -1. Along with -1. -1 means it will omit the constant term. So it will omit the constant term and it will do the fitting of the model. So whenever I don't want the intercept to be included as a part of the model, I can do this -1. So now again I can do the fit, right? So now the intercept term is no more existing, only the constant term is present. And I can take the summary of this fit to really understand the overall model. Okay, residuals wise, these are the minimums and these are the maximums. The coefficient is 0.5444 and the p-value for it is less than 2 into 10 to the power of minus 16. So the beta value is 0.544 and I could also see that the significance level is 2 into 10 to the power of minus 16, which is less than 0.05, and for this the null hypothesis says beta equal to 0, and because the significance level is less than 0.05, I can reject the null hypothesis. So beta is not 0, beta is very much greater than 0. So this is the kind of a relationship that we are building between the risk of the security versus the expected return that can come on this particular security. So this is the kind of a model that we have built, right? And look at the F statistic. P value is less than 0.05. So this model is much better than, so by looking at the F value in a linear regression, if the P value for this F statistic is less than 0.05, then I can very comfortably say that the model is better than random. Or the other way of putting it is, the model is having a lot of explanatory power, which also says that beta is not an ignorable value, beta is a significant value. So the null hypothesis is nowhere 0. I am rejecting the null hypothesis, which means these results are more or less in line with the CAPM model. Right? And even if I had removed the intercept also, the beta did not change. Even when the intercept was there or when the intercept was not there, the beta value did not typically change. And now I can simply look at some of the residuals, how the residuals came out. This is the kind of next level of analysis on the data before we make some kind of conclusions, whether the residuals are more or less independent or there exists some level of serial dependency behavior among the residuals. That's a different thing that we have to look at, which would be handled through the time series kind of mechanism. Look at if there is some kind of dependency among the residuals, then use an ARIMA model and so on and so forth. So to just understand if the residuals are more or less independent or not, we can actually get a plotting. So the regular plot of a regression model in R, when I use the plot on the regression model, it actually does a fitment of 4 different graphs, right? We'll see what they are, but it directly gives me 4 different graphs. So to watch these 4 graphs on one single screen, I'll create a kind of a space on my graph window where I'll split this entire thing into 2 rows and 2 columns. I'll say C2 comma 2, which says that my entire graph window would be split into a 2 by 2 kind of a space. So 4 graphs can be shown in one single space itself. And this is where I am doing a plotting of the fit. So all the 4 graphs which are typically given by the regression model are seen. So the residual versus the fitted values. So with respect to all the fitted values, when I am looking at the residuals are more or less scattered and the mean value is showing more or less plain. So which means the expected value of the residuals is 0 and the residuals are more or less scattered above and below. I don't see any kind of pattern with respect to residuals. And if you look at the residuals towards the extremes, the normality behavior is slightly distorted, right? A few values are quite away from normal. In a QQ plot, I can look at the standardized residuals versus my computed residuals, and I could see that very few values on either of the extremes are slightly deviating from normal. And looking at the standardized residuals versus the fitted values, again you could see a lot of scatteredness across. So there is not too much of time dependent behavior that we are seeing in this data at this moment. Now probably this is one way of doing the same, but if I really want some more information, I can also use my performance analytics package. I'll load, right? We have for doing a cumulative returns earlier, we have used that package. So I would use that performance analytics again to typically find out the CAPM's alpha. But of course, I think for this the data should be in a time series format. But let me just give you, there are a few functions like CAPM alpha, right? CAPM.alpha for calculating single factor model CAPM alpha. So I can give as an input RA, RB and RF. So RA is asset returns, RB is the benchmark asset which is my index, and RF is the risk free rate. So let's try this. CAPM dot alpha. I'll give RA, which is log returns TCS. Return or returns? Log return TCS. Then RB is nothing but log return Sensex. And I also have risk free, which is for the same period, the risk free rate of return. So this data has to be converted into a time series. Right, once your data is in a time series kind of a form, otherwise let me check. right? We can very well think of having drop equal to false. So let me just try it. Instead of taking log returns TCS like this, then let me take it as from the original data itself. Let me try. What is the original data here? Uh, Stock and index, right? TCS. These are all vectors. So stock and index, all rows. Second column, drop equal to false. But I don't think this will give, because the numbers are inconsistent. I mean, number of columns are inconsistent. So stock and index, out of this I'll take all rows, columns, drop equal to false, and same way I can look at the risk free also. My bar, take the second column, drop equal to false. Okay, real name should have standardized date formats and all that stuff. So I mean, unless I convert it into a time series, I cannot use. But I'll cover it as a part of another video. But just as a kind of an information for you, we have functions called CAPM alpha and CAPM beta, which directly give you the alpha and beta. But more or less, you can use this kind of a mechanism, which I have already discussed, the intercept and the slope kind of mechanisms to get your alpha and beta from the CAPM model. So that's how we can do for each of the securities. We can find out the expected returns based on the beta or the risk profile of the security. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.